All right, so we're going to dive into Bitcoin today, have some fun, I think, for this nice Easter Friday. And I think really understanding the market in a sense of where's the banks going, what does this look like for Ethereum with Shanghai coming up very soon, if it happens. We're going to break all this down for you guys today. I think you're going to like it. My name is Paul Barron. Welcome back in the Tech Path. All right, our live shows, we do this. Usually, we try to hold on this 3. Sometimes we get a little early. Sometimes we're a little late coming in. Depends on how fast the news is cycling and whether or not the crypto pit has got some updates that we want to crush into an episode. But the first thing we want to do is thank our sponsor, and that is iTrust Capital. If you guys are looking at long-term holding of your assets, digital assets, gold, silver, all those kind of things, you can do it in an IRA. And all you have to do is just go right over to itrustcapital.com. You will find a service there that I think is like no other. Check them out. If you're into IRAs and you want to do something long-term, this might be one of the routes for you to take. You can use our link down below. It's very easy. If you use that, you will get a $100 funding reward when you fund your IRA. So there you go. A couple of things happening in the news today. The jobs report, U.S. economy adds 236,000 jobs in March. Unemployment rate falls to 3.5. It's not necessarily moving in the direction that I think the Fed has been trying to get to, but the key here is that the job openings are slowing, meaning the number of jobs that are available are starting to slow, which means at some point we're going to see that intersection occur where number of jobs get to a point that there just aren't enough, hence the actual job numbers in terms of unemployment will start to go up. So that in itself is a potential to be a bit of a problem. And I think it will be one because many people now are looking at, well, what is this going to look like in terms of impact on the Fed with the next FOMC, which we have coming up here in less than a month. So going to be a lot there. Here's Squawk Box talking about this, using joblessness as a tool against inflation. Is it cruel and unusual, says McRomorel. So far, the Fed has managed to raise rates, and we've got continued job growth. We're in a new normal. Some economic theory from the 20th century may not hold true in today's global economy. This is a good statement because, well, let's listen to the clip, and then I'll explain what I think about this. Listen in.
And that's actually been the surprising part about all of this.
And, you know, right, Andrew, I've always thought that using joblessness as a tool against inflation is cruel and unusual. So far, the Fed has managed to raise interest rates, and we've got continued job growth in the economy. And I always think that we're in a new normal. Some of what we thought about in terms of economic theory from the 20th century may not hold true in today's global economy. And it's good that there continues to be a demand for workers. But here's one of the challenges. We've got maybe, 1 million more job openings than we have people looking for work. So long term, that's going to continue to put pressure on the labor market. It's going to be better for workers, but it's also a challenge as all of these new investments from infrastructure and the CHIPS bill enter the economy. What impact will it have? We've got to make sure that there's a continued investment in skilling workers and preparing workers and getting them ready for the jobs of the future.
Hey, Mark, I was thinking about it this morning. All the dislocations we've seen, crisis in the banking sector, that's going to...
All right, so let me escape out of that. All right, so a couple of things here he was talking about is that there is a lot of pent-up demand right now in the economy. And back to his point that they were making in the tweet is that this might be a new normal out there, and we can't necessarily use those kinds of analysis that we've used in the past decades to compare how the economy is doing, which gets back into how Chair Powell will respond to this in terms of whether we see another rate hike. Because I think a lot of people have still been pushing to a flatness on potential rate hikes. But at the same time, now with these new job numbers coming in, people are starting to say, wait a minute, here we go again. Is there another potential for a shift here? And I'll talk about that in a second. This headline, Bitcoin rests currently at 28K as U.S. jobs data boosts the new Fed rate hike bets. And this is the point that I'm getting at, is that if we see another rate hike coming in, likelihood is we'll start to see Bitcoin. Well, it depends. I mean, if we only get a quarter basis point hike, if I say that only, we shouldn't be, because remember, this is the fastest rate hike cycle that we've ever seen in the history of the Fed more so than Volcker, more so than anything that we've ever experienced, especially if you look back even in the 2008 run here. But a couple of points here that they state right here is the Fed's going to keep on hiking until something continues to break, even though I think the break has already occurred, the banking system. Non-farm payroll figures, macro data focus of the week came in slightly below expectations, indicating unemployment rising more slowly than predicted. That's the point I'm getting at, is rising more slowly. Another strong jobs report fuels speculations of a 25 basis point rate hike here coming up at the FOMC in May. Love to get you guys' feedback. Make sure and drop some down below or some questions in over here on the sidebar. Love to kind of get some questions for you. Do you think we're going to have some more pressure on Bitcoin and ETH and altcoins playing into this next cycle for the FOMC meeting? Or could this send Bitcoin maybe on up to 30K as anticipated by a lot of people, or even in some places, many people are looking to $40,000 this year as a high? Love to get your feedback. Make sure and spend some time here in a moment and hit the like button. That's the one thing you can do here to help the show, but also it helps others discover what's happening here in the crypto sphere and, of course, in Bitcoin and ETH. A couple of other points. They said they're going to keep going until something breaks. He continues about the Fed policy, part of the follow-up on Twitter. Labor market's still hot. I think this is a very, very short period of time. This is something we've talked about all the way back into December of last year. Get ready for mid-year. That's where I think this all occurs. We may get a little bit of delay on that mid-year because of the banking scenario and the amount of trust that the Fed is trying to re-enter in and inject into the economy, much like what we've done here with Silicon Valley. But I still think that mid-year, remember, it's only moving in. We're just now in April. We got May, June. Those are two critical months. July could be one that would start the process. And what I mean by that is that could be the scenario that plays in to the recession that really gets us moving in the right direction. Here's the Fed watch tool. If you guys aren't, checking this out, it's 25 days left before the next FOMC. And there's the chart right there. Right now, as it is still a little bit on the flat side, but most people are looking at a 25 basis points as a potential here right now. Love to know you. Love to know your expectation. Do you think we'll get a flat, no hike, or do we get a run at 25 basis points from the Fed? Love to get your kind of input. I think both of this plays maybe positive for crypto. 25 won't be as good, but obviously we go flat. I think the market's run. That's not something that necessarily the Fed wants to do, but at the same time, they can't be in a position where they re-enter a positioning of dropping interest rates too late, because that's that soft landing. You miss it, and it's like missing a soft landing 3 meters later. That's a hard landing and a death, which is a problem. And I think that's the challenge they are facing. Coming in from the Kobeissi letter, the Fed was created to maintain price stability, he talks about all the time, and maximum employment. Again, now that they are the source of inflation and want higher unemployment to control it, it's kind of the opposite. They've also destroyed regional banks in the process. Obviously, that's happened because of the way that we're looking at banks seeing deposits fleeing from their shores. And then now their actions are the exact opposite of the reason that they were formed in the first place. This is absolutely true. All of what he's saying is a perfect example of this. I want to get into this clip right here. I think I've got it at the right spot. This is by Peter St. And if you don't follow him on Twitter, check him out. He's a pretty good analyst, and he looks at the banking situations a lot. Listen to what he says about this silent bank run. Let me play this and I'll pull it up full screen for you guys.
The bank. For example, in 2020, interest rates were about zero, and both money markets and banks also paid about zero. But with rates almost 5% now, money markets also pay about 5%, but banks still pay about zero. Second is fear. In the 2008 crash, and again during COVID, money market deposits rose because of fear the banks would collapse. After all, the kind of people who move billions in and out know it's a Ponzi. They know that banks are permanently bankrupt, living handout to handout. Note, both hike cycles were smaller than today. The 2004 cycle was about 4 points in 2 years. The 2016 cycle was about 2 points in about 3.5 years. Today's is already bigger than both, and that's in a single year with more to go. So now we have a perfect storm. COVID fear, epic rate hikes, and a 2008 all rolled into one. All right, what does this mean for the rest of us? More pain. The reason is that thanks to Wall Street's fractional Ponzi, every trillion going out of banks into safer assets like money markets perversely shrinks the economy by several trillion. The fractional reserve pretend money vanishes. So yes, the economy is living on risk. This shrinkage hits hardest in loans. With trillions less to lend, banks will stop making loans. They'll stop renewing loans. They could even call in existing loans. So businesses are strangled. Essentially, the economy shrinks from its current counterfeit fortified size down to its true size. The artificial boom, based on artificial money, deflates. Unfortunately, right-sizing the artificial boom means a lot of bankruptcies. It means a lot of layoffs, a lot of jobless. If you like your job, you cannot keep your job. Of course, the economy is already shrinking, even today, without the extra help. In Wednesday's video, I talked about job openings crashing. They're down 1.2 million in about the past 2 months. And fresh jobs numbers this morning are already looking.
All right, so you're getting into the job numbers there. Good one there. Let me like that video. Great job. And I think the point with this is very intriguing in that he makes some very good, astute observations in terms of fleeing from the banking system. Remember, fractional reserve. This is a bank taking $10, loaning out $100. Okay, very simple math. When you start to see this vacation of or exodus of money, dollars, into these brokerage accounts, which are paying 5% on these money markets, this is the problem that Silicon Valley had, which is where they had this kind of digital bank run. This is that silent bank run that the Fed has even warned of. The big problem here, by far, hits credit, hits businesses, will hit jobs, and you have that scenario playing into where you cannot slow down the freight train before it crashes through the end of the freight line. That's the problem that we are facing. All of this is really good for crypto in essence, and I specifically mean Bitcoin, ETH, and some of the premium assets, because there will be flights to safety, and people might look at this as, well, wait a minute, I don't know if I want to necessarily go into a brokerage because of problems that things like Schwab has had and others. That'll be the big telling factor, is if we see Charles Schwab continue to see a little bit of pressure, that could open up the whole narrative around brokerages all of a sudden, not necessarily a safe place. So now you've got regional banks, you've got brokerages, and you've got risk. And this is the problem that we saw even in crypto when we started to see the fall of the likes of Celsius and Voyager. Those were microns compared to the size of the banking industry and the kind of impact we're having there. So a lot happening here for sure. Here's Jamie Dimon actually kind of reiterating a little bit of this about where this crisis may stop. Listen to what he had to say.
This is not 2008. Okay, this is much more limited. There are only a handful of banks that had this particular problem. They'll eventually be resolved one way or another, and I think then people should take a deep breath. In a week or two, a lot of these banks can be reporting earnings. I think they'll probably be pretty good. The Federal Reserve made some bold, dramatic moves to help it easier for some of the issues they had, and I'm hoping it will resolve rather shortly.
You're hoping?
Hoping.
But is the crisis over? You wrote in your letter there will be repercussions for years to come.
Well, that's different. I think those repercussions are regulatory. I acknowledge, obviously we have a problem, things need to change, but I begging the regulators, just take.
So I think that was where we wanted to cut it. Those repercussions are regulatory. So the point being is that Dimon is really looking at the banking system as this regulatory pressure that could control us. Remember, we had a lot of scenarios that played out in the Trump administration that did affect the banking system, and I think that's what he's getting into. The other thing is if you believe him, whether or not, because he feels to be, or it looks to be, painting a better picture here, trying to look at that. Remember, this is JPMorgan Chase. You look at the future of where a lot of these banks are going, it is going to be highly dependent on how solvent they are in terms of assets and deposits. That's why we can't see a lot of people fleeing to gold, why we see gold at all-time highs, or people going into Bitcoin where we see to be a little bit of a mini bull run. Or could we be looking at a new adoption cycle of where Bitcoin and crypto could be going long term? Another piece here from TYT. This was interesting right here from Anna.
But here's what Dimon argues in his shareholder letter. He writes, quote, Regulation, particularly stress testing, should be more thoughtful and forward-looking. It has become an enormous, mind-numbingly complex task about crossing T's and dotting I's. Ugh. I mean, being thorough when the health of the world economy is on the line is just so icky, am I right? I mean, in all seriousness, keep in mind that SVB was not subject to some of the toughest regulatory measures, including regular stress tests, because it had less than $250 billion in assets. In addition, SVB secured some interesting favors, if you want to call it that, from the Federal Reserve. As the Lever reports, in 2017, the Fed granted SVB a 5-year reprieve from the Volcker rule. The decision allowed SVB, a major lender to the tech industry, to.
So, all right. So this is. I want to kind of freeze it right here and read this for you guys. This was what Anna's talking about. Is the Fed granted SVB a 5-year reprieve from the Volcker rule. So the division allowed the major lender and the tech industry to remain traditional deposit-taking bank while using and maintaining its risk investments in venture capital. So that's the variation of these regulations on banks where they're saying, hey, you can't do these things because these are depositors' funds, and they allow that to happen. So it was a form of private equity that funds startups, tech industries, etc. Mainly it was because they were in the tech industry. This obviously has been greatly battered by obviously the layoffs and all those kind of things. So to her point, and I think to the point is that these big banks are trying to get even more favors because remember the Fed did this nice handout for SVB, which is a very small bank in comparison to the rest of the banks that are really potentially at risk here. And I think Dimon is doing what many bankers do all the time, pitching their own book, making sure that everybody is not doing this silent bank run within JPMorgan Chase. So remember, this could still be going into gold. We could see a lot more going that direction, still going into other assets, others going into exchanges or excuse me, not exchanges, but brokerages going into money market. So, or even directly if people are going to Fed Direct and buying just T-bills. All of that is a different way in which money's leaving the banking system, back to that earlier clip that we got into. So all of this really kind of flows into what it might look like going forward. So with that being the case, I want to jump to this next clip. This is from Anthony Scaramucci, a fund manager, Skybridge Capital. Let's play him.
Right now that we're through the bear market, and again, that is a guess. We don't know. But any time that you've held Bitcoin in a 4-year rolling interval, so you pick the day, hold it for 4 years, you've outperformed every other asset class. We made that position, we made that investment in November, December of 2020. We are up on that position. Now we're down from the high, and that's what gets all the press because the press likes car crashes. But we're
there, press likes car crashes. Just remember that Scaramucci's still Scaramucci, in the essence of saying don't just assume that these guys are all good guys. He makes a couple of good points here. You hold Bitcoin long, it's a reserve asset, it goes forward. But at the same time, that is a good message because any digital asset, especially in the early bell curve state in which Bitcoin and others are in, you almost can't make a bad bet. Now, granted, there are some out there that are absolute crap coins. Some of these are true high risk investments, super high risk, even though all crypto is high risk. The point is that some of these will go to zero. And I think just like in Silicon Valley, when I used to live there pretty much and work there, many of those kind of companies I knew were going to zero, but it was the 1 in 10 that I was looking for. Much like what we're seeing here with the crypto markets. We're going to see 1 in 10 of these projects that are going to be absolute barn burners and set the tone for this next generation of Web3 and what we'll see in all sorts of new technologies coming into the space. And even the asset class of Bitcoin and ETH, which I think are going to be the two big winners here, primarily because they're both commodities. That I think is where Scaramucci is going, is that this is still a good opportunity to be thinking moving forward, but will people continue to go in that direction? Here was Dan Tepiero simply saying, hey, we actually are looking at maybe some bullish moves here because it's rare that bullish setup is ever this good for NASDAQ, gold, Bitcoin, ETH. Normally it's one or the other or a couple and not the other, that kind of thing. Sentiment max bearish on assets. Next week's survey of CPI consensus expectation is 5.2 versus 6. That means coming down. That's a good thing, and that will be bullish. And a small downside surprise to even 4.8 takes us 10 years down near 3%. That means, okay, there's a potential of a nice run. Could we see the Bitcoin going to 30K? ETH running up to 2K very easily? Don't know. A lot of other factors, a lot of other fundamentals play into this. So it is an interesting time right now, guys, because it's almost an antithesis of what's really happening in the economy versus what's happening over here in the digital asset side. So it's very interesting. A couple other things that's kind of peculiar, kind of make you go hum, and that is this one right here. Just in, Bank of America and Fidelity both became top 10 shareholders of MicroStrategy. Very interesting. There's B of A holding total value 59 mil, and then you've got Fidelity coming in there as well. That's increasing position, 28% in position increase, or 28,000% increase, and a 47,000% increase. That's an interesting model when you look at what MicroStrategy's real core business is now, which is investing in Bitcoin. I mean, sure, they do have other business lines, which is great because it's kind of like our own business. You know, we have a lot of different media outlets in various industries, but crypto and digital is still one of my major areas that I focus time on, research, investments, things of that nature. So it's good to see that. Here was David Sachs from the All In podcast talking a little bit further around how all of this might be coming together with the need to raise the debt ceiling. And I'll talk to you a little bit about this after the clip.
We are headed for some sort of government debt crisis. I said that there's going to be three prongs to this financial crisis. One was these long-dated bonds having unrealized losses, which is causing problems in regional and community banks. The second piece of it's the commercial real estate crisis, which I think is metastasizing right now, which is also going to be a banking crisis once all those unrealized losses come to you. And the third piece of it is government debt crisis. We have this $32 trillion debt that we're now having to refinance at much higher interest rates. I read somewhere that half our government debt, so $16 billion, is going to come due, trillion, yeah. And it's going to have to be refinanced in the next 3 years. The average...
Yeah, there we go. All right, so I wanted to hear that, mainly. I wanted to hear that, refinance in the next 3 years. That's a very intriguing situation with what David's talking about there. And he's absolutely right. All of this is out there in the open. Everybody is starting to pick this up. Sachs is a great, he's a great value investor. He understands how to pick these things apart, and he understands finance. And that's the main thing here with how banks are going to be able to deal with this. And of course, obviously how the Fed's going to be able to push this in. So good there. And I'll show you something that will kind of surprise you. Here was Wall Street Silver coming in, says real estate securities are a weak point in our financial system. Sounds vaguely familiar. Here was the Blackstone REIT, limits investor redemptions again in March. This is a problem, guys. Commercial real estate is the last shoe to drop. It's one thing I've talked about for months and months, maybe even all the way to last year, is that real estate will eventually hit us in the mouth. And this one is big because of the financial component that ties in regional banks to where commercial real estate. And the flow of how all this affects society is real because of the fact that you have credit crunch, cause businesses to go into bankruptcy, lose jobs, furthering a absolute barreling train toward either one, massive layoffs, or we start to see massive impacts on what the economy is doing, and then the Fed tries to do something crazy on reversing, and then we see these double dip inflation scenarios. Those are the worst case, almost dystopian kind of situations. The other thing I wanted to highlight here was this. These are the biggest U.S. banks by total deposits. Let me kind of zoom in on these a little bit. All right, let's zoom up there. You got Chase, B of A, Wells, Citi, U.S. Bank, PNC, Truist, Capital One, and then Goldman Sachs, and then TD. All right. So let's take a picture of that, and then let's go, all right, well, let's take and look at which one of these are at risk with CRE, because CRE is kind of this next shoe to drop. So then you go over here to this insider piece. Let me go up to the top of the thing, just so we can scroll down a little bit. Commercial real estate loans are the next major risk. This is the one that's going to hurt because remember, you're seeing the exodus of cash. And they're going after and chasing that 5% T-bill, exiting into, Fed Direct, going into a money market, maybe flipping over into gold, doing a little hedge over here on Bitcoin. Lots of options out here, but not your bank. This is a problem. Now you look at the institutions. Who are the exposed? Wells Fargo, bam. JPMorgan, bam. Look at these. Total outstanding, 132 billion. That's billion. All right. Here we go. B of A, 76 billion. Truist, 53 billion. You have to look at the size of Truist overall. U.S. Bancorp, New York Bancorp, then PNC, 47 billion. This is a small regional size bank that could be at risk because of these kinds of things. These are the problems that could lay up into what I believe is going to happen, and that is a culmination of maybe 5 or 6 banks that survive. Herding all that money right into those 5 or 6 banks, and then eventually locking the door behind you and simply saying, all right, we've got our answer. Our answer is the CBDC. We have FedNow in place, and all of this becomes reality. Now let's hope that that theory is wrong, because that theory would put some heavy pressure on not only the United States, but it would put some heavy pressure on just the reserve, the US dollar, and what we look like to the rest of the world. And that will be the big question that I think plays out right after the next presidency, which is in 2024. So granted, you can mark my word, we are going to see an absolute blitzkrieg of movement next year and the latter of this year of campaign scenarios playing out that are moving in this direction. I just was on with Corey Clipson of Swan Bitcoin, and we got into that. We're going to drop a video on that. Is this whole idea of the narrative around CBDC and even FedNow? Because remember, FedNow is a payment system. CBDC, that's a completely different thing. That's a store of value, or we'll call it a store of value. But the real scenario is playing out how all of this might get into a digital dollar that can be turned on. Once we get to that state, that's when we are in centralized control. And that is the most deafening state that we could ever potentially go to. And that's why being able to look at decentralized assets as really the only way out of the system. And of course, Bitcoin, as you guys know, is one of them. ETH, I still am a big fan of where that's going. And I still like a lot of digital assets that are going in this direction. So there's more and more, which we'll cover a lot here on this channel. So if you're new, make sure and just hit that like button right now. And make sure and subscribe to the channel. All you have to do is just subscribe and hit the little bell there. It'll give you notifications of when we go live. And we do all these breakdowns. And if you like these kinds of breakdowns where we do this narrative, we put together the stories that support it, we put the research behind it. Listen, this takes a team. And our team they're really great. They do a lot of hard work in the background. And we do all this for you guys to help you learn so that you can go out and make good decisions, make your own decisions, learn your own path on what you want to do to make yourself your own sovereign individual. Hopefully that's working for you guys. All right, we're going to jump to a Crazy Friday poll. I'm sure this is going to be another hard one that the pit's throwing at me. Let's see what you guys say. All right, here we go. Where will Bitcoin be on Easter Sunday? Of course, they give me 30K and 26K. These are like trick questions. Right down the middle at 46 and 54. So you guys are thinking it's on the high side of 28. I think it's on the low side of 28 on Sunday, but watch out for Monday. I think Monday we might see a rip. However, if you look at sentiment on Bitcoin right now, just to get into Bitcoin sentiment, dipping a little bit, let me kind of zoom in on that, dipping a little bit, but still staying solid and very close in terms of amplification and top line sentiment, which as you guys know, if you follow our CPI data, 2 sentiment types. Kind of your mass market sentiment, how everybody thinks about Bitcoin, and then the real Bitcoiners and or people that are actually investing. That's amplification. It's the red line. If amplification is hovering around top line or intersects with it, that's typically when we see fireworks. It happens so many times, it's almost automatic on sentiment data as to what happens in the chart. Then you look over here at ETH. ETH moving up a little bit, even though top line is down slightly, just slightly, but AMP still on the up. So what does that tell me? ETH could still be on the upside, even though we're seeing a little bit of a retracement down into the mid-18s. Love to get your feedback, though, and your idea of where you think this might be going. Let's get to some questions. Hilldog says, what businesses flourish as a result of banks centralizing their power? Well, businesses flourishing. The problem with that's a good question. I think that almost deserves its own video. And the reason is because you got a lot of cash businesses that will almost disappear overnight with CBDC. That's a problem because there won't be cash to be used. We actually talked about this in a video earlier this week. Then you have businesses that will be relied upon for international, which I think is going to be the factor right now. We'll start to see a lot more pressure on international businesses, including our own. I mean, we have a media company that we're in 109 countries right now. This show, 109 countries. We have members all around the world, and we're only at about 48%, 46% of US in terms of our audience, our membership, all that. So we would most likely get affected because I think eventually we're going to start to see some international pressures there. So that's a big one. 3CDO says, hi Paul, considering how the hell Canadian banks held during the GFC 2008-9, do you feel banks in the US will follow the same or similar more regulated Canadian bank structure? It's possible. That's exactly what we were talking about there with Jamie Dimon and his clips. He's basically, he's doing his carnival move right now, which is go out there and pitch, because he doesn't want these regulators to come in and say, don't put a squash on us. We need that freedom to run, which I think they'll do a deal to be into that top 5. Bitcoin has been undergoing rigorous stress testing for several months. It's looking good. I think it's looking fantastic. Because now we know that there's a belief in this asset class. Because before, I think a lot of people weren't sure completely that this asset class could stand the test of time, the test of a huge bank situation. It happened, no problem. The question will be if we get a real black swan event, with a major, like a 2008 event. Guys, we're running just first innings here. So be watching. That is what people I think are worried about. Reals for thee, not for me. Yes, for sure. You can't bank run XRP. No doubt about it. Decentralized is all the way. Fed's going to raise rates until something breaks. Man, they're breaking stuff left and right. 2018, bottom came. That was another 10 years. That's true. June will be a critical game changer. I totally agree with you, Road Rage. We're going to see a lot of shifts in June because it is a magical number in the cycle of when rates began to shift. The amount of time that you need for those trailing indicators to catch up to market, CRE, credit. I've been talking about this for a year, and all that happens middle 2023. Mike says, ETH to 2K in the next 10 days. That's probably a good guess, Mike. I mean, we may see that kind of run. And if ETH hits 2K, obviously with Shanghai, we'll see some. Most likely we'll see a little bit of run there. Love to know how you guys are playing it. Drop some comments down below. We always love to get your insights. Of course, if you guys are not involved in our Diamond Circle, get in now. It is where we drop a lot of additional research. We do additional podcasts, more content, my own personal audio notes that I do on these kinds of shows. I drop weekend stuff in there. It's a lot, even more than what you get here on YouTube. So just join. It's very simple and it's easy. Click the link down below. If you want to reach me, it is out there on Twitter @Paul Barron. We'll catch you next time right here on TechPath.